Hello, it's Monday, the second day of March 2009. This is Brian Shannon from AlphaTrends.net. The market had a pretty miserable session here today. The NASDAQ lost 89 cents or 3.3%. It shouldn't come as a surprise as we are in a primary downtrend and the market has been worsening lately. Friday we had seen the $28 level give up as far as any level of support, and the market had found resistance there intraday. We also had the declining 5-day moving average, and when that 5-day moving average is declining, you want to look at the market as guilty till proven innocent in the intermediate term, or what I consider the intermediate term, which is 1 to 7 days or so. On the daily time frame, we've got that declining 10, 20, and 50-day moving average. There, you want to look at the longer term as guilty till proven innocent. And for investors, when we have the market below the 10, 20, 30, 40-week moving average, there is no reason to be invested in stocks. It's as plain as it gets. We're in a bear market. We're coming down towards lows not seen since 2002 in the NASDAQ, 2003. But as we'll see shortly, the NASDAQ does continue to hold up better than the rest of the market, the broader market that is. This level still looks like an important area for the market potentially to head down towards maybe 24 or so. It seems like a long ways away, but really it's only about 2.5 points away at this point. So the market trend remains guilty till proven innocent. I don't think we've seen the worst of it still, because the volume's been declining here the last couple days, and what it means is we're basically running out of bids in this market. So I think we still may see that knockout punch, and in terms of percentage move today was pretty good sized, and the headlines read levels not seen since 1996 and that sort of thing in the S&P 500, but we haven't seen a real fearful capitulative rally on this real big surge in volume. So I think that's really what we're going to need to see before we can clear the way for any rally that might unfold. And a rally that might unfold could lead to several weeks of higher prices, but there's no point in being early. Everyone who's been early has been wrong so far, and it ends up costing a lot of money. Sidelines is a much better position than cash. Sidelines is cash rather than being long rather in a declining market. So we've got that declining 5-day moving average. We'd seen the $28 level give up on Friday. Today we'd seen this 27.50 level give up, and basically the market tried a little bit of a rally here in the afternoon, but it remained below the daily VWAP, which in the VWAP was declining. So you have to look at these things as really no reason to buy unless you're just in super scalp mode. By the way, I apologize for the having to cancel that live session yesterday and the audio troubles I had on the recording on Friday as well. I've got that temporarily fixed by using an older machine, but I still have some issues, so I'll be working on those the next couple days. Let's take a look at the Russell 2000. It lost 5.6%, and this is the market that over the last month and a half, 2 months, I've been most concerned about, in particular when it gave up this support level in here. It's been this little bearish pennant that I pointed out last week, and now we could look at this as what would the price objective be for that pattern, and basically we could take the height of this and subtract it from the breakdown point, which is right in about where we are. We're also seeing that this 37.12 level was tested, the lows, and taken out, so that's good to see. It would be nicer to see a heavier increase in volume on this decline. That would mean capitulation and basically maybe that the last of the stubborn longs are giving up in here. And realistically, this bear market may still have years to go. We still need a time correction, so there's really, even if we get a rally from here, it should be a sharp rally most likely. As all the sellers are worn out of the market, and when it begins to rally, there won't be much supply, so everyone will be chasing it. Shorts, will be chasing prices higher, scrambling to lock in their profits. That'll bring sidelines cash in and that sort of thing. So we get powerful rallies in a bear market, but it needs time to heal, and it's still several months, 6 to 9 months away at a minimum, I think, before you can look at this market and consider buying it as far as any investments. This level level still looks realistic, down near 34 in the Russell 2000, so a test of the 2003 lows down near $34 a share. It's only about $3 away here, so less than 10%. That could occur in the course of 1 or 2 days here. So again, no reason to look at anything here as being optimistic. Forget about value, forget about PEs, and forget about all those traditional valuations. This market is being ruled right now by emotion. The emotion is fear, and people, when the markets move on emotion, the collective intelligence of the market, as they say, shrinks to the lowest, the level of basically the dumbest participant. And look at some of the people in this market. There's some pretty dumb people out there. So we can still get a lot worse is the point. We had heavier volume here at the end of the day. I don't think you want to read into that at all, but we did close right near the lows. We stay below the daily VWAP in here all day, so there's no reason to look at anything as down too much, or compare it to any historical measure or anything. History is made, and perhaps this is the bear market that every bear market going forward will be compared to. The important thing is to keep your equity intact. If you're not trading the short side, keep your equity intact so that when we get a turn, you can participate in that. And then, as always, the job is simply to manage risk. The financials are where the biggest risk remains. Obviously, this group was down 6.3% today. New closing low. It did maintain, was able to hold above the intraday lows set last week, but obviously a new closing low. Lighter volume in here. That leads us to believe that, again, the capitulation isn't there, but maybe we're running out of just participants in this market. Maybe we've just scared everyone away. So you have to be ready for anything. As far as what happened in here last week, we had seen this trend line give up, and then that 7.5 to 7.5 level we came down and tested on Friday. Today we gapped down through that level. This market looked like it was going to rally in here, but again, when you've got such bigger picture problems on all these other time frames, there's no reason to trust any of these moves for more than just scalp trades. Eventually, one of these rallies is going to turn into the bottom, but how many of those false rallies have we seen? You just cannot look to buy the bottom. It's just not realistic. There's no one who can do it with any consistency at all, period. The S&P, let's take a look at oil. Oil, again, continues to be super volatile in here. It's in a downtrend, so that's the most important thing. Any rallies in here will continue to be guilty till proven innocent in oil. We'd seen that this market got up towards this prior level of support, found resistance just about that area we were looking at for it, which was about 27.5. So oil, we had seen Friday made a lower high and a lower low. Now it continues lower. The trends are aligned on multiple time frames. It's guilty till proven innocent. No reason to be trying to pick a bottom in there. Let's take a look at the S&P 500 right now. The spiders were down $3.33, or 4.5%, as we had seen, and I pointed out earlier on the blog that these are lows not seen since 1996. Here's a potential area where this market may find support. Now, this level is about $64 to about 68.5. So 68.5, 69, and then just below that 64. So we're still obviously in a horrible bear market. There is no reason to think that you're going to pick the bottom here. The market continues to just slay anyone who thinks that it's down too much or that the values are too strong to pass up, because we're still obviously at multiple, more than a decade lows in here, 12-year lows. So nothing encouraging about this chart at all. We had seen a new closing low on Friday. Today another new closing low on the 30-minute time frame. We had seen that last week's inability to get back up above that 78.5 level that was the prior support, which did then act as resistance. The market was rejected there. And again, pay attention to the direction of the 5-day moving average. It's more important what is the direction of that moving average, as is any moving average, rather than where the market is in relation to it on a closing basis. This prior support acted as resistance Friday. The market was rejected late there. Today, on Friday, we obviously saw the gap lower. We saw a slight rally, hardly worth Well, if you got part of that rally, for me it was hard to trust. I didn't participate, but we saw a higher high and a higher low, and then a lower high. Market broke down, a lower low here, down below daily VWAP, and then it pretty much continued to sell off all day long, except for again that late day rally, which came up to the declining daily VWAP on diminishing volume. I was looking at it as, hey, well, maybe we're going to turn around in here. You have to always be open-minded to those scenarios, but when the volume shows that the buyers aren't becoming more aggressive there, that you have to be very careful. I had posted some charts on Twitter saying basically don't trust this because of the volume, and it looked more likely that we're going to continue lower. And again, I still think we're going to continue lower below that $70 level. Probably tomorrow. That seems obviously pretty likely. You have to keep your mind open to the possibility of a turnaround, but do not just blindly guess where the lows are going to be. Instead, wait for a big volume movement. Wait for the market to, let's say this is tomorrow's trading right here. Let's say we gap lower, maybe we continue lower, rally up strong like this. Then if we can make a higher low, then maybe you want to purchase in here with a stop below that level. Or let's say we come down and make a lower high, and then like this. We want to look at a higher low and higher high, and look at the definition of trend. On 1 minute time frames, that's where you start. If it can hold on a 1 minute time frame, then you look at a 2 minute time frame, then you let the market tell you to decide how long to hold. But obviously risk remains super high to the long side in here. We're in a vicious bear market, and nothing can seemingly change that right now.